Well, thanks, Alison, and thanks, Dave, for the opportunity to present today to you. And it's good that we've got a number of researchers and an entrepreneur, which is fantastic. So if anyone's thinking of raising finance in the UK or Europe, hopefully this will be useful to you, but also useful in connection with what to look for in venture capitalists, what sort of style they have. And I'll finish the talk by giving you some best practice guidelines that can be used for if you were setting up a venture capital firm, for instance, for yourselves. What are the best ways of doing this? So, as Alison said, I studied at Glasgow University. That's over on the left there. That's where I got my PhD in venture capital. And the Adam Smith Business School at Glasgow University was founded in something like 1450. So it's one of the fourth oldest English-speaking universities in the world. And I teach at Henley Business School, which is over here on the right, part of the University of Reading, a bit more modern. In the 1890s it was founded. Got about 25,000 students at that university. But I actually live in Windsor, and of course Windsor's always in the news, one way or another, with royal weddings or whatever it might be, or Prince Andrew. So it's great fun living in Windsor and seeing people from the royal family around all the time. So that's a bit about me. Now, this research is something which I've been pursuing for the last 8 years or so, and I used to collect the data on venture capital investments and performance when I worked for PwC. So I worked for PwC for many years, including 3 years here in Pittsburgh. I worked in the US Steel building with PwC, and was a great supporter of the Steelers. I'm wearing my Steelers tie today because obviously they did so well yesterday. I got really interested in why the performance of European venture capital firms and funds was rather less than those in the US. What might the reasons be for this? I started the research in around about 2010 and worked very closely with the British Venture Capital Association, which is the UK's equivalent of the NVCA here in the US. And really got them on board with pursuing this research. And you can see here, I'll just blow up the data there a bit easier so you can see it. In terms of the returns for Europe have been considerably less than the returns for the US. This is longer term returns. More recent returns, though, indicate here that the UK is catching up. And indeed, if you look at some of the Cambridge Associates data that's been produced very recently, it's showing that actually Europe is excelling over the US for the very short period of returns, the 1 year, 3 year, 5 year returns. But in the longer period, the UK, Europe is still behind the US. I guess this was the sort of starting point here. Back in 2010, this blue graph there is for the buyout performance of buyout funds in Europe, and you can see that that's for Europe, this is for the US. It's pretty much the same on the buyout side. The blue line is pretty much the same. The green line is for venture, and you can see how much bigger the US returns have been compared to Europe. It's probably even more marked when we look at the UK returns compared to buyout returns back in 2010. You can see that buyout funds are achieving around about the 15% per annum to 17% per annum return, which is what private equity generally gets as a whole. There's poor old venture at minus 0.3. So the reason, well, why is this happening? Things are getting much better in Europe. This is some data here in terms of the activity, in terms of investment, well, in terms of funds raised and then investments we'll look at in a minute. So on the fundraising side, 2018 was actually the best year for European venture capital funds, raising the most money ever at 11 billion euros. And we've had some pretty large funds being raised in Europe. Rocket Internet, Atomico, around about the $1 billion level. I mean, we're not raising the massive funds that you have here in the US, like Sequoia in Silicon Valley, it's $8 billion fund, or indeed the Japanese SoftBank fund at $100 billion, which is pretty much distorting the market. And if we look at the funds raised overall for Europe, this is the latest data from the European Private Equity Association, you can see here that venture capital funds raised round about the 11 billion euro level. For buyouts, though, it's more like 66 billion euros being raised for buyouts, so substantially greater for buyouts as you might expect, because buyouts have achieved the much better returns historically. In terms of investments being made, whilst global venture investments were $255 million, in Europe, again, we had the best year ever for European VC investments at 8.2 billion euros, substantially less, of course, than US or indeed China. And if we look at the latest data I got for this year, quarter 2 of 2019 for the money tree, from the money tree survey that PwC puts together, you can see over here there were just over 1,500 deals in the second quarter of 2019 in the US and North America. There were just over 1,100 in Asia Pac, and there's Europe at 786. You can see the difference in the size of the money being invested. So Europe is falling behind a little bit, but as I say, the returns are improving. If we look at where the money is coming from for European venture capital funds, if we look first of all at the buyout funds here, 37% of all the money coming for buyout funds is coming from pension funds. So this is the institutional pension funds, people like CalPERS and so on, who are putting most of the money in for European buyout funds, 37%. But when we look at venture capital, pension funds are only contributing 9% to venture funds. And the bulk of the money, or the biggest share of the money, 18%, is coming from government agencies. So because the institutions aren't putting money in, and they're not putting money in because the returns have been so poor in the past, it's very dependent on government agencies. Now, in the case of Europe, that would be the European Investment Fund, which contributes something like 40% of the money to all new venture capital funds setting up in Europe. And going forward, for the UK, the British Business Bank, which is a relatively new government agency, is putting money into venture. They've got a £2.5 billion fund, which is being used to put money into venture in the UK. You can probably see that even more noticeably in this chart here. If we look at venture funds being raised 2018, where is it coming from? Pension funds 9% for venture, 3% the previous year, 11% in 2007, but for buyouts it's 37%. Then you look at government agencies, 27%, 2017, 18% there, but for buyouts it's only 2%. So you can see the dependence of venture funds in Europe on support from the government agencies for funding. But with much better returns coming in currently, we're hoping that there'll be more pension funds investing in European venture going forward. So that was really my starting point. What was the reason for the poorer returns of European venture historically? And I adopted a qualitative approach to this research. Most people would actually take a look at a lot of data, do regression analysis, statistical analysis and so on. I wanted to really sit down with venture capitalists and find out what they were doing in terms of their investment practices. So I interviewed 64 separate VC firms, 70 investment executives in total for 64 firms. There were 24 in the UK, 25 in the US, including 4 of the Pittsburgh VCs, which is pretty much most of the Pittsburgh VCs, as it happens. Silicon Valley, 13, and continental Europe, 15. Round about an hour's interview, semi-structured interview. We explored things as well as going through particular areas and looking for themes to arise from those interviews. Now, I also interviewed, well, in fact, you can see here the structure of the sample size in terms of small, medium, and large VCs, funds, whether they were focused on IT or life sciences or indeed on both, or whether they were very early stage or sort of early to later stage venture. And I conducted so many interviews because I wanted to get a good selection of all these different types of VC firms and funds. But I also interviewed a number of other stakeholders, in fact 40 other stakeholders. including limited partner investors, of which there were a couple here in Pittsburgh, also entrepreneurs, advisors, and so on as well. And this helped to support the conclusions that were coming out of the VC interviews. I also had a questionnaire which I used to rate various areas of the investment practices of the funds in terms of importance on a Likert scale. So that was basically the sort of sampling, and my framework essentially was that I was going to look at structural factors around the funds, operational factors, and the wider environmental factors affecting the funds. So the structural factors are things like the size of the funds, what sectors they invest in, the backgrounds of the partners. Operational factors are essentially the investment practices of the VC firms, how they go about sourcing deals, how they go about appraising deals, evaluating deals, structuring deals, monitoring deals, and then exiting from deals. Then the wider environment are things like the cultural aspects of these firms. What sort of propensity to risk do they have? The ecosystem that they are operating in. Silicon Valley is very unique, for instance. Even things like luck. A lot of VCs say that luck is very important in having to land on a particularly successful investment. So let me go over the key findings then. Well, the first thing was that, unfortunately, I guess for the research, is that the performance of the US VC funds in my sample was better than the performance of the European VC funds in the sample. And indeed, the US funds had some funds which were operating at greater than 50% per annum return. And it was only US funds which had this greater than 50% return as it happened. And we'll come on to that again in a minute. So it basically confirmed that there is a research gap, at least for the sample of firms that I interviewed. Now, of course, you have to be careful with this sort of sampling, qualitative sampling, because your conclusions can really only apply to your sample. You cannot really extend it to the wider population because it's not statistically significant. But nevertheless, I think the results have implications for best practices across the VC network. What else did I find? The fund size. Well, US VC funds were rather larger than European funds, UK and continental Europe. Average size of just over $280 million, more like $168 million in the UK. And in fact, in the last few years, we've had a lot of new VC firms set up in the UK, which have very small fund sizes, even 20 million or maybe 50 million. But 168 is a pretty good size of fund. Some of the older established VCs in the UK would have fund sizes of, say, $300 million. Basically, we don't have enough finance available to support companies in the UK going forward. We can find, I guess, adequacy of pure seed funding and startup funding from business angels and syndicates of business angels, from crowdfunding, and from some of the VCs that do invest in these early stages. But we don't have enough money usually to provide for later stage finance to allow companies to scale up. So a lot of them will tend to come over to the US to get funding from US VCs, or indeed, these days we're seeing a lot more US VCs coming into the UK to invest at the later stages in UK companies. And the problem for the entrepreneur, of course, is that they have to keep always having to go out and fundraise all the time. They raise funds for a particular aspect of the business development, then they have to go out a year or two years later to raise more funds. Whereas in the US, you tend to get enough money to take a company through at least its initial stages when it sets up. The other interesting point in terms of the structure was the background of the partners. So partners in the US at venture capital firms tend to be much more operational and entrepreneurial in terms of their backgrounds. In the UK, in Europe, they tend to be more investment banker types or corporate finance people or accountants. That again is changing, and certainly a lot of these new VC firms that have set up recently are more likely to be set up by former or current entrepreneurs who've made a lot of money and now setting up their own VC fund. but it's a lot more sort of entrepreneurial and operational, which can have lots of implications for value add with the companies. So US VCs tend to be sort of ex-entrepreneurs. Some nice quotes here from the interviewees. And these slides will be available to you afterwards, so don't bother about trying to read everything necessarily now. Moving on to operational differences, I think that it's really summarized by saying that the US has a much higher propensity to take risks, much more risky culture, whereas in the UK and Europe it's much more risk averse. Not entirely, but more concerned with protecting the downside rather than capitalizing on the upside. And this is borne out by the investment strategy that these firms approach. So you can either have an investment strategy whereby you invest, say, more of a growth strategy, and you're looking for maybe a 2 times or a 3 times return on your investment, or you might have what I call the 1 in 10 strategy, where you are counting on one investment returning the fund as a whole and making a massive return. It's a much more risky. You're going to have a lot of bad investments, but hopefully you get this one very good investment. And basically, out of, say, every 10 investments, usually for a typical venture capital firm or fund, 3 might be complete losses, complete write-offs. 3 or 4 may return just what you invested. 2 or 3 you might get 2 times maybe back, and you might get 1 or 2 which achieve a 10 times return, or indeed many, many more times than 10 times return. When Benchmark invested in eBay, they got 100,000% return on that investment. Of course, that's what we're looking for, those sorts of returns. Of course, from a VC's point of view, there's 2 dilemmas, if you like. One is investing in something which they shouldn't have invested in, and of course it makes a loss. The other one is missing an investment which they should have invested in. There's a firm, a VC firm in Seattle, which publishes the ones we missed. Didn't invest in Starbucks, for instance, things like that. So errors of omission and errors of commission. The other thing is in terms of the investment theme. US VCs spend a lot of time researching into what might be the next big hot area for investment. So they want to be ahead of the curve. In Europe, it tends to be more of a case of following on from this and not being quite so aggressive and focused on this analysis of trends. So, I mean, the sorts of areas that we are investing in Europe are very much the same as the sort of areas you're investing in over here. You know, these are current sort of hot areas for investment: deep tech, autonomous vehicles, and so on. Of course, you're doing an awful lot with that here in Pittsburgh. Fintech, actually, it's nice to say that fintech, I just saw it in the Wall Street Journal today, London is confirmed really as the capital for fintech. There's more fintech investments being done in London than anywhere else. So we do have a big advantage in terms of fintech. We're also doing quite a lot with artificial intelligence and biotech as well in the UK. But many of these areas are sort of hot areas. But what we're trying to do, of course, is find what is the next big area going to be. These are the ones which have been invested in and are currently being invested in. So one firm calls it those prepared mind initiatives, developing what might be a future area for investment. 10 times a year, another US VC is sitting down and doing a lot of brainstorming and thinking about what is our next investment area going to be. It's all about spotting a trend, essentially. And we just don't have enough of that, I guess, in Europe. But again, it's improving. Deal sourcing. So this is finding the deals. In the UK, there's a lot more, and certainly continental Europe, a lot more actively going out to find deals, proactive deal sourcing. Whereas in the US, I found that the brand names of the US VCs was enough to get people to come to them. So, for instance, if you go into Silicon Valley, you will see entrepreneurs with their business plans going out of one VC firm's offices into another VC firm's offices, and so on. The brand name of people like Accel and Sequoia, Kleiner Perkins is attracting VCs to them. and their profile in the marketplace, their track record of previous deals. So personal networks and proprietary contacts, much more important to UK and continental US, continental European firms. Of course, VCs in the Valley can pretty much rely on deals coming into them in the Valley. They don't necessarily have to go out of the Valley to find deals. Having said that, because it's so competitive in the Valley to do deals these days, they are going much further afield, and that's what I mentioned earlier, that we are seeing US VCs investing in later stage deals, certainly in the UK. There's a lot more of that. Something like 20% of all deals had a US VC investing in them. Now, in terms of deals flow, some firms might get as many as 3,000 introductions every year, a huge amount of introductions. This could be business plans being sent in, but Andreessen Horowitz, which is a fairly new VC firm in Silicon Valley, probably set up in the last sort of 8 years by Mark Andreessen of Netscape, they get actually 3,000 warm introductions. So these are introductions coming in from advisors, accountants, lawyers, and so on as well. And of those 3,000, they invest in 15 a year, which actually is quite a lot for a VC firm to invest in. 10 of those are going to fail, 3 or 4 will survive, and 1 might join the unicorn club, which means that it's going to have a valuation of $1 billion. And then every so often, a unicorn might in fact become a huge company like a Facebook or a Google. And there's a nice quote here from Mark Andreessen. He's basically saying that over 20 years, looking ahead for 20 years, the returns are going to come from these 1 or 2 investments, which are going to be the Facebooks of the future. And you never quite know when a Mark Zuckerberg is going to walk into your office. So again, it's the brand name of Andreessen Horowitz, which is attracting the future Mark Zuckerbergs to walk into their offices. So deal flow, deal funnel is very important. If we go on through the investment cycle to the due diligence stage, once we've decided that we're interested in doing a potential deal, how do we go about carrying out our assessment of these deals? And I divide this into what I call internal due diligence, which is the due diligence done by the VCs initially on the potential investments, and then external due diligence, where you bring in the experts from outside, the lawyers, the marketing experts, and so on. Now, I found that in the US, most of the due diligence was actually done in-house, because the US VCs have the capability to do that in-house. They have investment partners who have a background in the sectors that they are investing in. So they're able to check out the technology themselves, rather than bringing in outside people. And in fact, this US medtech VC here is saying they only invest in areas where they do have this expertise in-house. Contrasted with the German VC, we always bring in know-how from our board of advisors, or the networks of those guys. So we're bringing in people from outside the actual partnership of the firm. Once we've once we've investigated a potential investment, the next thing, of course, is to decide whether we're actually going to make the investment or not. So how do we go around about the investment approval process? Most venture capital firms will have investment committees. So the investment committees will usually comprise the partners, and they will usually meet on a Monday morning, and they will look at potential investments, and they will also look at existing investments in the portfolio and decide what they might want to do. In the US, I found that these investment committees were comprised just of the partners working in the firm. Whereas in Europe, you may well bring in external people, advisors and so on, into the firm as well. Or you may involve people who are ancillary to the investment process. You might bring in more operational type people into the investment committee as well. And certainly I met with one US limited partner investor who said that they will only invest in those firms where the decisions are made by the senior partners. The partners who've been through the ups and downs of the various cycles of the economy and the venture capital cycles, who've been through the good times and the bad times, those are the guys who really should be making the decisions, not the wider firm. In some UK firms, it may involve all the people in the firm in coming up with an investment decision. Also, most VCs will look for a unanimous approach to reaching an investment decision. So everybody has to be comfortable with making an investment. If just one partner doesn't want to do it, then they don't do the investment. Otherwise, they may have a consensus approach where everybody has to be comfortable in making the investment. And if somebody's not quite comfortable, maybe they want some more due diligence to be done, so you go away and do that, and if that's satisfactory, then you can actually reach more of a unanimous decision. The problem with consensus and getting everybody on board is that you are more likely to miss out on the outlier investments. In fact, there's a nice quote from Kleiner Perkins, who was not one of my interviews, but there's a quote from them which says basically that they would never have invested in Google had John Doerr, their senior partner, forced it through, even though the other partners didn't want to do it. So consensus can kill the outliers. Investment terms. Having decided to invest, we now need to come up with the investment term. So overall investment term is how much do we invest for how much equity. But of course there are many other terms in a term sheet or offer letter. Things like veto rights, consent rights, liquidation preferences, all these sorts of things. And you can divide these terms into entrepreneurial-friendly terms and investor-friendly terms. And there's a marked difference between West Coast and East Coast, even here in the US, and certainly between West Coast and Europe. West Coast are much more entrepreneurial-friendly. They certainly wouldn't have anything like multiple liquidation preferences or insisting on dividend streams. Whereas even on the East Coast, Boston, they're much more likely to insist on some of these more investor-friendly terms. It's all summarized really by saying, Europeans are saying, how do I not lose? And Americans look at the question, how do I win, which is a comment from a US VC. In other words, we're looking to protect the downside with these investment terms. What happens if I invest in this company and it goes bad? How do I get most of my money back? That's not even a consideration with Silicon Valley VCs. They just want to see the company grow as big as possible. And of course, it's quite rational to have this more protective situation because things have gone bad in the past. So you might want to protect the downside. Some companies, some firms insist on a dividend stream. Now, insisting on a dividend stream is a bit silly, really, because you're looking to grow this investment and make a huge capital gain on the investment. It doesn't really matter if you're going to get the odd few dividends coming up to improve your IRR. And so there's a particularly acerbic quote here from a US Silicon Valley VC about Europeans' approach to this. Syndication. This is when VC firms syndicate with other VC firms on deals. They might be syndicating for monetary reasons. In other words, they don't want to risk all their money on a particular investment, so they're bringing in other people to share the risk with them. They might want to bring in the expertise of other VCs to help evaluate the deal or to help do due diligence on the deal, or indeed to help add value to the deal going forward. And I didn't really see any evidence of less syndication activity in Europe compared to the US. Everybody is syndicating quite a bit. Of course, syndication de-risks the investment and therefore is seen as a particularly good thing. Some VCs prepare not to syndicate because they've had bad experiences. The problem with a syndicate can be that the syndicate members may have different aspirations. They may have different attitudes to risk. They may have different approaches as to when they want to see a realization of an investment. Particularly if you're trying to raise a new fund, for instance, and you haven't really had many realizations. You're showing sort of unrealized valuations in your portfolio. You really want to get some investments done. You're under a lot of pressure from your LPs to show some returns for your next round. So you may want to exit a bit earlier than perhaps other people in the syndicate might. You might be investing at a later stage than some of the other syndicate members. So all of these things can arise with syndicate members. And of course, VCs, not just US VCs, tend to syndicate with people that they respect and trust, that they've syndicated with before. if you've had a bad experience with a syndicate member, another VC firm, you don't want to syndicate with them going forward, really. So we tend to invest with the same half dozen friends consistently over time. I did find that US VCs syndicate perhaps less with European VCs than vice versa. It's very common for European VCs to syndicate over here because the companies want to raise more finance for later stage growth and so on, and to scale up. And I found that there was less willingness to invest, I guess, with European VCs because of the differences in approach to risk, particularly, and some of these attitudes about dividend streams, exiting too early, and so on. A lot of evidence of US VCs, particularly in Silicon Valley, clubbing together with other VCs at the very early seed stages. So you might have 4 or 5 of the big Silicon Valley VCs all investing relatively small amounts of money, maybe even only like $200,000, in a very, very early stage entity and clubbing together with each other. This is so that they can get a foot in the door, if you like, on a future Facebook or something at that very early stage. And one of the US VCs actually has a small fund which it uses to invest purely in these seed investments, which is quite interesting. And it's quite common for the VCs to be working together on a deal like this, say in the morning, and in the afternoon they're all competing with each other on another deal, trying to get in on a particularly interesting deal from an entrepreneur. So clubbing together is a very, it helps to lower the risk. It helps to get them in at an early stage. But I certainly one Silicon Valley VC didn't want us to have the impression that they are basically gambling or they're just throwing money at potential deals. I mean, they are trying to evaluate them as best they can. They're not doing the full due diligence as they would on a bigger deal. So they're not just throwing money at deals. Having invested in a companies, then what do we do in terms of reviewing how well those companies are doing? Carrying out portfolio reviews. I mentioned that VC partners will usually sit around on a Monday morning and go through their portfolio and decide what action needs to be taken, if anything, on the companies. In Europe, there's a tendency perhaps to keep investments going for longer. What I mean here is bad investments going for longer, when really you should basically walk away from it and spend your time looking after the more successful potential investments. And the reason why you might do that is because a particular partner, say, is invested in the company. That partner is not going to be very willing to give up on the company because it doesn't look very good on his CV with the VC firm. So we tend to keep companies perhaps going for longer. On the other hand, bad companies going for longer. On the other hand, we tend to exit too early on the better companies. It's all down to the fact that US VCs have a much bigger size of fund. They can afford to take a few write-offs. The partners are also generally wealthier than they are in Europe. But there's one UK VC here that carries out a very formal triaging every 4 times a year, every quarter, of all their investments. So that's a very good discipline to have. And indeed, a focus on metrics to gauge the performance of the companies. What have we seen before with these companies in our portfolio? What can we expect might happen based on past performance? And US VCs know exactly what metrics they're willing to fund because they've seen it before. Adding value. How do VCs add value to portfolio companies? Well, many different ways. They may provide connections to other VCs, to suppliers, to customers. They may provide further funding. They may find executives, headhunters. Famously with eBay, Benchmark found the first CEO for eBay, which was Meg Whitman, who was chairman of HP until a few years ago. So there's a lot of adding value activities, but what I found is that really there wasn't that much difference between adding value in Europe, say, and the US. If anything, I found there was more adding value going on in Europe than the US. And indeed, a comment from a number of VCs, particularly in Silicon Valley, was the best companies are the ones where we have to add the least value because they are just such good companies that we don't have to do anything to help them. And a number of people made this point. So now we get to exits, the final stage of the operational side of the process. US VCs tend to wait for the best exit rather than exiting too soon. And again, I just mentioned they may be under a lot of pressure from their investors to exit. They may be under pressure from the management teams to realize some of the management teams' equity. We have a less receptive stock market in certainly the UK and continental Europe. We don't have a pan-European stock market. There were attempts to create NASDAQ Europe, but it wasn't successful. There were attempts to create ESDAQ, which is the European equivalent of NASDAQ, but that wasn't successful. So what we basically have are separate stock exchanges in Europe. In the UK, it's the London Stock Exchange. They have a very successful AIM market, alternative investment market for younger companies, and that has been very successful. But there's only about 2 tech companies on the London Stock Exchange's top 100 companies. It's not very receptive for tech companies. They tried to do something about this a few years ago, and they created what they call the high growth segment for the London stock market. But they've only ever had one company list on it, and this was primarily meant for tech companies to list and then before going to the main market. So it's a lot easier to exit in the US. There's a lot more likelihood of getting trade sales from the big tech companies in the US as well. The Googles, the Amazons, the Facebooks, and so on, all of which have got billions of money for investments. Okay, so finally I looked at the wider environmental area of the process. I've looked at structural areas, I've looked at operational areas. Now let's have a look at the sort of environment in which the VC firms operate. So the first thing was, excuse me, was the culture, the attitude to risk. As I said right at the start, we are much more risk averse in Europe than you are here in the US, which is a pity. Things are getting better, but I guess we've had our fingers burnt too many times. You can even say it's in connection with Brexit, which you've probably heard about. We're sick of hearing about it in the UK, but half the population wants to remain. The other half want to leave. You could say that they are taking a riskier view there, or maybe they're just tired of being told what to do by the Europeans. It's an interesting point, and we'll see what's going to happen in a few weeks' time with the general election. So I think it's really summarised in this comment here from the US VC. How do I win is the approach in the US versus how do I not lose in Europe. Very nice quote there, I think. I mentioned about the wealth of US VCs. Obviously you have many billionaires at Silicon Valley VCs like Kleiner Perkins and Sequoia and so on. They can afford to write off the odd investment. They can afford to take greater risk because losing part of the investments they personally made in a fund is not going to be quite so onerous to them as it might be in Europe. Other things which make it a bit more difficult, fragmented markets. Europe is a collection of different markets. Doing business in France is very different from doing business in Germany and so on. They all have their own laws, regulations, and so on. Cultures even, tax systems, politics. There's a nice quote here from a German VC. They find it easier to do business with US VCs than with other VCs in Europe because they don't know the legal environment in France and so on, which is interesting. More open ecosystem. Yes, interesting that particularly in Silicon Valley, they talked very much about the sharing culture that they have. They're much more likely to share things with other people. Maybe they'll share with entrepreneurs or they'll share with other VCs compared to a more proprietary approach in Europe. It's my deal, I'll keep it to myself. A lot more philanthropic. You can see that just walking around here. with all the many donations that have been received for this building. Everybody, all the names you have, we don't have that in the UK. We have very small university endowment funds, particularly. It's well known that it is difficult to scale companies in Europe. A lot of people have done a lot of research on that. The whole sort of tech ecosystem. Basically, wherever I went, people were saying there's just nothing like anywhere Silicon Valley. People have tried to recreate Silicon Valley, but it just hasn't happened. This is Sand Hill Road, which is the main, if you like, Wall Street for venture capital in the US, with many, many venture capital firms based there. This is just one address in Sand Hill Road, 3000 Sand Hill Road, which has something like 27 or more VC firms headquartered in just that one location. So we do have tech ecosystems in other places, of course. This is Startup Genome's latest ranking of startup tech ecosystems. This is Silicon Valley #1, New York City #2, London's #3, and Beijing #3 also, joint, Boston and so on. So we do have, obviously, very successful tech ecosystems in other places also. But the Valley is just so overwhelmingly networked that it's really difficult to try and recreate that in other places. It's coming from a UK VC and indeed a UK limited partner. What else is an issue? Lack of good CEOs, serial entrepreneurs. So we do have good CEOs in the UK. We have good serial entrepreneurs. We just don't have enough of them. Don't have enough of them to run these interestingly high growth businesses. And finally, I mentioned about luck. So quite a lot of interviews said that there's a lot of luck in this whole process. Of course, you can sort of create your own luck to a certain extent, but it is quite an important element. There's a nice comment here from a UK limited partner investor. If there were UK managers who had seriously successful funds, I'd say it wasn't luck, it was skill, but there have been too few seriously successful funds. And also a comment from a US entrepreneur about the luck involved in finding Google, Pinterest, Facebook, etc. very, very early on. So let me just spend the next few minutes talking about some of the characteristics of the better performing funds. So just in summary, from what I've been talking about so far, I've been talking about structural differences between US and European firms. I've been talking about the operational differences listed here, the wider environmental differences, and my thesis is that all of these differences have an impact on the historic difference in performance between European and US VC funds, and why US funds have done so much better historically. If we look at those funds which have had consistent top performance, I found only 2 US firms, 1 continental European firm and no UK firm showed consistency of top quarter performance across all their funds, which is interesting. A number of academics have looked at private equity particularly, and it used to be regarded that if your first fund was successful, then the chances were that your second fund and third fund would be successful too. But actually, academics are now showing that there's no actual, that's not necessarily the case. And in fact, you can have a completely first-time fund set up completely new, which might be more successful than established funds. So this consistency of performance, of top performance, is not necessarily that common. What I did find for the top performing funds were that they engaged the 1 in 10 high risk approach to investing, looking for home runs. They used the theme approach for finding new investment areas to invest in. They had partners with operational and entrepreneurial backgrounds, and they had entrepreneurial friendly terms, and there were a number of other areas as well. So those areas were common to all the consistent top performers. And then if we looked at the outlier performing firms, so these were firms which had funds of greater than 50% per annum return. So only 9 in my sample of 64 funds had outlier performance. And they were all US VC firms. And they all exhibited this 1 in 10 approach to investing. They used the theme approach. They are partners with operational entrepreneurial backgrounds. They had a very high profile, not surprisingly, so they got lots of deals coming in. And they used the entrepreneurial friendly terms. They also used they intended to use a consensus approach to investments, though certainly one of them, the senior partner could force deals through. So these outlier firms, which result in investments like Facebook and Google, were more common in the US. Now you do get some UK European firms that do achieve excellent returns, and in fact the best return I found was 260% per annum, but the best in the US was 720% per annum. Okay, so to summarize on the research, it basically confirms this performance difference. Now, having said that, as I said right at the start, the difference in performance, which is historical, is getting narrower and narrower. And indeed, some Cambridge Associates data is showing that there are some European funds which are outperforming US funds. So things are definitely getting better. But nevertheless, I think that many of these differences in investment practices still remain. Certainly talking to VCs recently, that's the impression I've got. The new findings from the research were the operational entrepreneurial backgrounds of the VCs, partners doubling up on deals, which I didn't touch on so much at the moment, the theme approach, the 1 in 10 approach, use of entrepreneurial terms, the brand name of the firms, and the less proprietary approach, and so on. So these are all new findings. It's well known about the uniqueness of Silicon Valley environment. But what I did find is, from my interviews, because I interviewed 64 VC firms, and I interviewed 40 other stakeholders, the other stakeholders generally agreed with what the VCs were telling me. So that sort of summarizes, if you like, the differences between Europe and the US, which is important to know if you're thinking of raising money from, say, a European VC or a UK VC. Just be aware of the overriding difference, which is they're going to be much more risk averse than in the US. Having said that, it can be a better environment because it's far less competitive than the US, certainly Silicon Valley. Because it's far less competitive, from a VC point of view, it's better because the valuations that they are going to give are going to be lower. Of course, it's not so good from an entrepreneurial point of view and wants the valuations to be higher. Now, you can take all these findings, and you can come up with, if I was setting up a new venture capital firm today, how would I set it up? Taking the best aspects of all of this. And so I've come up with a list of guidelines for best practice VC investing, which are listed here. They're all the things we've just been talking about. These are and you can look at this later. These are all the structural areas. You want a fund of adequate size to enable you to follow on with your initial investment. You don't want a fund that's too big that you're going to make some rather inadvisable investments because you're forced to make lots of investments. You don't want it too small. And academic researchers like Josh Lerner and so on at Harvard have said that there is a sort of optimal fund size. It's round about the sort of $300 to $400 million level. If you've got investment partners with the deep sectoral knowledge, that's going to help them not only source deals, it's going to help them do the due diligence on the deals and indeed add value to deals as well. Take the risk to invest in early stage and use this 1 in 10 approach. Have partners with entrepreneurial and operational backgrounds. Of course, it's good to have a partnership team with all these different types of areas of expertise. So you want operational, you want entrepreneurial, but you also want people with an investment background and corporate finance and accounting sort of backgrounds as well. Get the partners working together on the deals. There's too much, certainly in Europe, there's too much it's my deal, nobody else is going to help me with it or work on it. And then on the operational side, again, we have the points that I've been talking about just now. Get the investment decisions made by the investment team, not by people external to the investment team. entrepreneurial-friendly terms. Syndicate with VCs who are known. Collaborate on early-stage deals. Use a metrics-based approach to monitoring your portfolio companies. Get rid of the poorer performing investments. Don't exit too early. Wait for the best exit. On the wider environmental side of things, think big. Have an ambitious culture. Share information with other VCs, with entrepreneurs and so on. Make sure you've got really good working networks between not only the VCs and entrepreneurs, but also the big tech companies. And luck is a key factor in all of this as well. So if you want to read more about this, little advertisement here. I have a book coming out on the 13th of December, published by Taylor and Francis Group, which basically covers all the points I've been talking about today, including the best practice guidelines. So that was a very quick run through all of this stuff. Thank you very much for coming and for listening. Hopefully you've got some questions, and I'll be around till certainly 2 o'clock if anybody wants to have a chat afterwards. If any of you think of doing research in this area, what I want to do going forward now with my own research is to extend all this into China, because I really want to see what's happening in the Chinese environment. How do they go about their investment practices? I suspect it's much more along the US lines than say the European lines, but I'd be very interested to see. And I'm hoping to form relationships with a number of Chinese researchers and so on. Okay, thank you very much.